we have Jason DeLorenzo, whose name I've spelled wrong almost every time I correspond to him. Is that right?
That's right. Yeah.
It's sometimes they call you Jason Derillo. I mean, it's.
Well, with your name, you're probably used to it. So
I am used to it. Well, welcome back. You were on the show a while back. I think we're going to cover maybe three topics, three different videos. So topic number one is what again?
We're going to start talking about variance risk premium.
Okay.
Just a quick introduction.
Perfect. So we're going to do that, and then we're going to move maybe to some gamma hedging and then some vega hedging. I think we talked about. So we'll do, as I said, we'll do this in three different episodes. Yeah. Perfect. Okay. Well, welcome back, Jason. His fund is right behind him in the screen. Ad Deum.
Deum
funds. And we'll put in the video
www.addeumfunds.com.
Easy enough. And we'll have a little place card for that as well. Okay, right. So go. You're in control now, Jason. Have at it. You run the show here, and I'll ask questions.
All right. So I mean, you tell me, Lex. We'll have a conversation. Why were options made in the first place?
Well, so I could go down there and try to make a lot of money when I was a young guy. That's why. I mean,
that's it.
No, it's a great way to the leverage and an ability to defease risk is tremendous, right? And it's such a good derivative product. You don't need to have a ton of money to buy and sell stocks, which you do if you're going to buy and sell stocks. You can do it with options and effectively create a very similar strategy with far less capital. However, there's some trade-offs. There's a bunch of Greek components that we talk about that you have to somehow manage a little bit, right? At some point, right? So I think it's a terrific investment tool. It's gotten a bad rap, but it's coming around. People thought it was really risky. I think completely the opposite. It's not as risky as you think.
I agree. The things you said toward the beginning is why we're here talking about variance risk premium, because basically it is a hedging kind of because of its convexity. It has more than, you were saying Greeks, it has more than one variable associated with it, which creates a situation where a binary movement in the underlying can create more returns in a percentage standpoint than if you just hedged or just sold or did, in pretty much any other product. So it was made as an insurance product. And just like your car insurance or your home insurance, any insurance, they all have the same kind of characteristics with, if I get into a car crash, then that payout, it's kind of like a put where that payout is a lot more in that short-term time frame. But over time, I've had to pay premiums on my car insurance in order to have the issuer make money. And options are the same exact way. And that's what we're talking about now is how do I measure the premium in an option compared to the chance that it is going to pay out. Okay. So I'm going to share my screen.
Okay, good.
Slide on variance risk premium.
So let me ask a question while you're doing that.
Yeah.
You mentioned insurance. I use that analogy a lot. However, one thing, and maybe you don't agree with this, which is fine. One thing that insurance company do is they sell premium. Okay. And some of the pros, at least in my era, we sold premium too. Okay. We always thought it was a better proposition to be short premium and manage your inventory with short premium, kind of like an insurance company does. There's actuaries who figure out, payouts and all that sort of stuff, right? And they're selling premium is what they're doing, right?
Right.
So I don't know if you have a thought on that. We can do it along the way. Is being short premium better than being long premium? I know you can't just blanketly say that, but
right. Well, I mean, the reason why I'm sharing this is because since I have SPX, historical volatility, implied volatility, and the difference between the two, volatility being kind of the premium from a flat dollar and cent standpoint. And you can see that gray line, which is the difference, is pretty consistently positive. And this is on a monthly standpoint. So if you were to sell the 30-day at the money option, or I think this one is it's kind of like VIX. It's a amalgam of all the options and the
Sure.
premium. If you were to sell a big, huge group of options, and after 30 days, you would see that it's going to return on the aggregate positive number. Sometimes, to the point of being 10%, you can see that the gray goes up there to that 0.1.
Sure.
And sometimes it goes down negative. What these big spikes in volatility, you can see 2009, that was a huge market spike down. And then here, the COVID spike down in 2020, you could see that it is not always great to be short volatility in order to make money. It's a nice consistent way to make money, but it's not perfect at all times.
Right.
So basically what this is saying, though, is that for the right to have this insurance, you have to pay a premium that is fairly consistent. It is around the 5 to 10% area per month, and it's very desirable to try to harvest this. But other than variance swaps, which is an institutional product, it is very difficult to capitalize on this. So right over here, these bullets are kind of describing what this is.
Yeah, I'll mark it off. There you go.
Yeah, the options are overwhelmingly overpriced. 5% per month is a lot of money.
Sure it is.
Yeah, I'll take 60% in a year, even if I'm not counting compound.
So why is that, Jason? Any thoughts on why is it always 5-ish% overvalued? That's the premium in options over actual underlying move. Is that correct? Or volatility?
It's the difference between the implied volatility and the historical volatility over 30-day periods. And the reason why is because really there's greater demand for it. I mean, if all these institutions, hedge funds that are all long stocks, every single one of your 401ks are long stocks. You're not short stocks for the most part. I mean, I don't have a 401k that can short stocks, but and so these have to be hedged. You have annuities out there that are taking capital, investing long in equities, and they need, since fixed index annuities are promising no losses when the market goes down over certain time periods, they need to hedge those long equity positions with something. And as you said, options are very attractive because of how convex they are. So all of these entities are in demand of this insurance. And there's not as many dealers out there that are desiring to give them that liquidity. Well, there's enough though that I guess like 5% is the magic premium number that supply and demand has determined to be a good equilibrium for this kind of product for the price on a monthly basis.
Okay, makes sense. I think I was one of those persons. They came to me for the prices, and you know what? I'm in the business of making money too, right?
Right. And the great thing about this is when it comes to options, they're not necessarily in the business of making money. Kind of like I don't buy car insurance in order to make money on it.
Absolutely.
They're in the business of hedging. They're in the business of risk management. And so really what you're trying to do, what you were doing as a dealer, is you're trying to build up enough capital that when this 2009 drop happens, or this COVID drop happens over here, that you're able to take it on and you're able to pay out, and you're able to hedge your insurance positions sufficiently.
Okay, you ready for the $1 million question? Which,
sure,
if you have an answer for this, this is going to be impressive. Ready?
Oh, okay.
So here's what I want to know: how can we determine when this occurs, or is occurring, and this occurs, or something is occurring, and can be predictive of this? Is there a way to figure that out?
So I mean, honestly, I had showed you prior and in my prior video about the VIX and SPX relationship and how closely correlated they are.
Right.
As you deviate from that, you can kind of sense tremors in the volatility space when people are recognizing a certain number of orders, when dealers are recognizing a certain number of orders coming in that are basically changing the equilibrium a little bit. And when that is noticed through either that VIX and SPX relationship or some other indicators, things like through the gamma hedging or Vanna hedging, when you start seeing different shapes in the term structure, you can begin to sense that there is something big on the horizon. That's kind of where I go to look.
Okay.
That $1 million question, if that was really answered, I would like to know the answer, if that's definitively answered. But you can sense the tremors in the volatility space when it starts to happen.
Makes sense. Okay, good.
Yeah. So like as I was saying before, a lot of people, a lot of people I talk to who read about this ask, well, how do I capture it? And there are quite a few ways that are tried other than the variance swaps that I mentioned earlier. Some is passive selling of SPX puts, and then doing something called delta hedging. That delta hedging is when you using your pricing model, and we'll just say Black-Scholes for it to be the most popular.
Sure.
It signals how many shares of the underlying you buy or sell in order to hedge your position, that the movement of the underlying does not affect it.
Okay, let's give an example. Let's just take a 50 delta option.
Okay. All right, so a 50 delta option would be at the money.
Yep.
And even intuitively, we could think you have a 50% chance of going up or down. And we'll kind of assume at this point in time that it's a normal bell curve that we're using. You have a 50% chance of going up or down, then you would want to, let's say you're long a call, you would want, the dealer is long a call and you want to delta hedge it. You have positive 50 delta, and so you want to hedge it by being short 50 shares of the underlying. Right.
So that in that 50 delta concept, right? So just as a note, so some of our beginner options folks, call deltas are positive, put deltas are negative. Okay, so that's something to know. And if you sell a put, the delta in it is going to be a negative times a negative, which is going to be a positive. It's going to make you long if you sell a put. It's completely the opposite with the call. So I just want to make that clear for some of our newer beginner options folks.
Yeah, and a question was asked not too long ago, and somebody asked me, what's the opposite of buying a call? And I had to think about that, because really there's two opposites. It's either selling the call or buying the put, and they have very different payout structures. They have very different market structures, and so it's kind of difficult to say. In their mind, they were saying, well, in both of those cases, I will end up short the underlying. If I buy the call or sell the put, I will end up long the underlying. But the payout structures are so much different that you can't really you can't really equate the two.
Right. That's a good point.
Overall, though, option dealers like you were and like a bunch of computers are now tend to be short puts, because really the premium is in the insurance of losing money in, like you said, from annuity or insurance companies. So they are trying to charge enough premium to make themselves whole if there's a problem in the future.
Okay, let me interrupt again. Sorry. You're bringing back fond memories of me selling puts, my selling puts. So pre-87, way before your time. Okay. We had a skew curve that was uniform around at the money. It didn't really have any skewness to the, upside skewness to the put side. once the crash came, it proved to people like us back then that you might want to charge a higher premium for an out of the money put versus its counterpart on the out of money call side at an equal delta. Negative 25 on the put, let's say positive 25 on a call, very equal distances away, let's say.
Right.
So what happened is after that crash, we had something called skewness, and all of a sudden out of the money puts became more expensive because we learned that downside crashes are volatile, violent, and fast moving.
Yes.
Right. So now that's all we see typically is that skew in effect in the marketplace, right? Puts are dealers like are always asked to sell those downside puts. And there's no reason why we would do that at an equal level to the call if we can get more premium for it, and people are always going to demand it. So it's going to push that supply demand component up, right?
Right. And most of the time too, calls are used as almost like an upside premium collector.
Yep.
It's like you said, when crashes happen, they are going down fast. You don't want to be selling the puts and not be hedged in any way.
Correct.
But going up, there's very few, unless it's like a bounce from the bottom, there's very few times where you are going to have institutions sell calls on the upside in order to get some premium, in order to pay for some of the puts on the downside too. So they they're exchanging capping their upside for hedging their downside. Because of that though, it's not even really even a smile that's even, but it pushes the demand for calls down and the supply for calls up, because now dealers have to take longer call positions.
Right. I was typically in that position all the time. Always long upside calls and short downside puts. And then, we managed all the middles. So
yeah.
Yep.
So unfortunately, there's no pure way to harvest this premium. I mean, you can try to, sell. A lot of people try to sell SPX puts, and then try to hedge them and manage them. There's also other volatility products that are not very pure as far as, there's like VIX futures, and there's VIX options, and then there's options on futures, and then options on options on options on futures. Forget about that. But yeah, so I mean, there's so many different products that are using the same statistics and the same pricing models and the same underlying to hedge, that it can get overwhelming and complicated to even try to measure. And also try to hedge and try to capture this premium that exists. But essentially though, if you were to short at the money puts and calls, really do a straddle every month, you can try to harvest this. It's just very dangerous in case you get spiked.
So can you throw in like the long legs on that, make it a condor or an iron condor or an iron butterfly? Does that make sense at all?
So that makes sense to fix your risk, definitely. But then once you start doing something like that, then as you had stated before, there's this skewness to the options. So you end up buying, even though, yes, you have butterflies or condors or something, you end up buying more expensive options to hedge your less volatile options. So it's helpful, but it's not a pure way of doing it. And plus, most people, when they do this, do not have the capital to back themselves up. And if there is a spike in one way or another, they're going to get hurt. I see a lot of income, probably one of my introductions to options was the income strategy, which is routinely sell or buy butterflies or sell iron butterflies, condors, trying to collect premium to a certain profit point and then selling. And that's good. And I think for the most part, I mean, everybody is short volatility in their life. I mean, you get a job and you're hoping not to be fired. You're hoping for things not to happen wrong. When you drive a car, you don't want to use your car insurance. You want to buy it. You buy your car insurance.
Nor do you want to use your seatbelt ever. You want to use your seatbelt, but never have to have it tested.
Right.
Right. That's insurance too, that seatbelt.
Yes. And so is the airbags.
Right. Exactly. I never want to see them deployed.
Right.
Yeah.
So everybody's kind of short volatility. To go against that is, you want to go with that flow the government and the Fed, and everybody is trying to keep everybody's 401ks afloat and keep people happy and prosperous. So it is, kind of, it goes along, that income strategy goes along with that kind of mindset. However, you kind of have to keep an eye. You don't want to blindly, I'm always against blindly selling condor or buying condors and butterflies, etc., without looking at the vol space and looking at the skewness of and the kurtosis of the volatility space.
Yep. How would you instruct, an intermediate level self-directed investor, trader, whatever you want to call that person, to get a good grasp of that, right? Because some people are going to use a service like yours, and other people are going to want to do a little bit on their own.
Right.
So should they invest in some sort of implied volatility study? I know there's platforms out there that have that, so they get a feel for how steep or flat a skew is, and trade accordingly, or too much to.
Well, one thing that so I do a few things that are kind of like that, but one thing you could even do other than just observation is even looking at the vol workshop in TradeHawk. You can see the skewness at any given time of the option space. I go into skew a little bit more with Vanna hedging because the out of the money options are much more sensitive to volatility changes than the at the money. So that's, there's a source of directional influence there. But yeah, so as far as like skew goes, the one thing that I found personally that can help before I had any tools and before, I knew of TradeHawk or Squeeze or anything like that is go on your platform and just do an at the money butterfly. It almost doesn't even matter how wide it is, but do, a sufficient wideness. And you'll see that the returns, even though you're at the money and at expiration, if the market were to close until expiration, you would maximum money, you would notice that your P&L curve is skewed, is moved over to the put side, that you are negative deltas with an at the money butterfly. And kind of, I'm just saying intuitively, when you could just eyeball something like that, you can look at how much skew there is in the market when you just see that kind of shift in the deltas and in your P&L.
No, that makes sense. That's a good observation too. So
there's many more things that you kind of have to account for. And once you start going down that rabbit hole, I'm just saying that the beginning trader, the beginning options trader looks at things in that way. And as soon as you start going down that variance hole, you start seeing all these different aspects of options, stuff like this variance premium that you have to pay attention to, or data that you have to pay attention to when you have a time limit on your return, or the implied volatility of the option. I think the market's going to go down, so I will sell a call. All of a sudden, your call may be down, even though your thesis was correct.
Right.
Or, is there dividends or interest rate changes, which rarely happens, but still.
Right.
Or is there earnings coming up? Why is my option so expensive? And you look, just because you wanted to try to capture something in earnings. And you start going down this rabbit hole, and there's plenty of papers, white papers, scholarly articles, journal articles that describe all of these kind of aspects of options. And so I think it is important to look at, study these and look at them. And the other thing too is that options are such a dynamic trading tool and dynamic investment tool that there is always something new being presented about them. It's probably not that long ago when you were there and you were short puts and long calls all the time, and they were learning different ways in which to calculate your deltas, calculate how much you should be hedging, and what your VIX changes are, what your Vanna changes are. And that's still changing now, even though there's computers doing it. There's maybe just different people changing the computers. Stuff like strict delta hedging that we were talking about before is very subject to whiplash. if I go down and I go back up to where I started, I'm down if I'm strictly delta hedging because I'm buying or I'm selling on the way down or I'm buying on the way or
right. Yeah. That was the negative gamma scalping model, right? You just hope the underlying doesn't move enough to make you have to make a decision.
Right. I think though that it's extremely important to understand the dealer world when you're doing options because they are the largest holders of options.
Right.
And so whatever they're doing to manage their risk, it will help you predict how you can act in your things. And that's, this variance risk premium is the first like of the set of these next few webinars that is trying to show what dealers are trying to do. So
good. Okay. Awesome. All right. You want to stop it there and we'll take a break?
Yep. That sounds good.